Aloha everyone, Joshua Hayes at BigWaveTrading.com. I hope you have had and are having a fabulous weekend. As we head into Monday, I would think that this market, based on the trend lines that I've drawn and just its overall price action, is going to chop around some more. As you can see, just looking at the Russell 2000, you can see that while we're above this one resistance line, we haven't gotten above the all-time high resistance line. We are finding support here. We've got a pocket pivot point signal on heavier volume, so it all looks good. And this support level is starting to line up with the 200-day moving average, and then the 50-day moving average is below. So there's 1, 2, 3, 4, 5 key support levels here, but overall it's still range bound. So the Russell 2000 looks good, but like I said, the market still looks like it wants to trade sideways. The NASDAQ 100 is broken out to new highs, is starting to find some a price level here at these old resistance levels. Now, hopefully these old resistance levels become support. If not, a retest of the 50-day moving average in this first support line should be in order. But looking at the S&P 500, you're still not above that one resistance line. So even though that we have a few support levels, we have a few key resistance levels above. Hence my overall commitment to thinking that the market is still overall just range bound. It doesn't mean that certain stocks can do better than the others. It's just stating that looking at the Dow Jones Industrial Average here also, you got 3 resistance levels ahead, only 3 support levels below, so it's pretty much even overall here at the Dow Jones Industrial Average. But the Russell 2000 kind of taking the lead, and the NASDAQ 100 continues to overall be the best performer. If this continues, I think the market can find a floor and move higher. But I want to make it very clear. I received more long signals in one session than I have since the presidential election when you combine the new longs and the ad signals, and they're all in quality positions. But I need to make it very clear. Friday was not only options expiration, but it was the S&P 500 rebalancing. I knew that it couldn't just have been options expirations that made the volume jump like that. I finally figured it out that the S&P 500 rebalanced. Hence, we had a ton of moves on big volume. But here's my thing. I have 11 new long positions, 4 ad signals. And if you would think that, okay, well, they're all fake out signals, I would think that maybe I wouldn't have that many, and for however many new long signals I would have sell signals. There were a lot of stocks that broke hard following Friday's session due to this rebalancing, the options expiration, but the trend was already in place for most of those stocks that ended down. The only 2 high, quote, quote, high quality full sell signals I had was in the perfect speculator name, RIB-T, and in the perfect speculator name, STML. Besides STML and RIB-T, which besides being perfect speculator aren't the most highest of quality merchandise out there in the market, I didn't have any full sell signals in quality merchandise. That being said, look at all the long signals I got. SGY, GSM, PRTY, HEES, CMC, BBY, BY, USAT, CBMG, SAIL, IOVA, HERC, KFRC, TPL, WTT. You can pretty much see that all the chart patterns look the exact same. They look great. If Friday happens on no news and I see what I see in these chart patterns, just like this, and I know that there's no rebalancing, and I know that there's been no options expiration, I would think that this market is going to explode higher, just absolutely rip higher. As it is, all of these signals are coming due to options expiration S&P 500. The track record lately with these dates are good for new long positions. The vast majority of the long positions I take on these options expiration dates have been working within the overall uptrend. That being said, to think that all 11 new signals and all 4 ad signals are going to work is absolutely insane. So I'm approaching all of these long signals. First off, I always approach everything as if they're all going to fail. I'm going to be wrong on every single one. So risk control, risk management is priority number one. I don't want to lose a lot. I want to lose less than 1% of my account capital in each of these new positions. That way, if they all fail, as I'm not going to lose 10%, 15% of my account capital if they all fail, I'm going to lose very, very little because I have some tight initial stops. I do not have time to go over the stops, but if you just look at SGY, GSM, PRTY, and basically look at their Friday lows or Thursday lows, that's your first stop. And for most traders that are new, that should probably be your only stop, because if it doesn't work immediately and it moves lower, and let's say it takes some time to work higher again, and even if it moves higher without you, in this tape, I can guarantee we're going to get more signals. This is insane. When you don't have a market that stair steps higher or pulls back for any significant amount of time, allowing me to be able to separate the leaders from laggards, I can't tell what's the best and what's just good. So I have to approach every long signal basically the same, since none are perfect, and since no perfect or near perfect patterns are setting up. I want you to look at the long signals I take now and go review the past big winners from 1998 to 2008. Tell me that those aren't the exact same chart patterns that I'm buying today. They are. But two things are different. Those chart patterns are much prettier. They've got a lot more accumulation and green bop in them. Those aren't around anymore. The byproduct then also is those chart patterns, those charts, and those stocks produce very large gains. We no longer get large gains. I put two stocks on my top current holdings update on social media, SODA and CUTR. I think SODA is only up 252%. Cutter's only up 102%. Go look at some of those old returns. So you can see where it's different. So since that's the case, and since I can't trust any one chart over the other, I'm treating them all the same. Now, I'm basically almost already fully invested. I don't have a lot of capital on hand. So I can't even put 1% capital into each of these new positions. The most I can put in each of these new positions on my end is 0.5% of my capital. That's only going to be anywhere from about $2,000 to $2,500 per trade. That also being said, I'm putting $2,000 to $2,500 per trade, and I only pay $1 commission. I live on Maui, which means from the market close to the market open, I have from 10 a.m. to 3:30 in the morning. I have from 10 a.m. to 3:30 in the morning to enter my orders and manage my trades. This is what I do for a living. So if I want to spend 12, 14 hours just messing around with my orders and stops, I have that time. But I try to post the limits and the stops for you guys to follow to make your work on life a lot easier. What takes me hours to do takes you just minutes to do by reading. So with that being said, please, please, please do not take, if you're new, take any position where the stock is extended from the 10 and 20-day moving average or 10 or 20-day moving average, like SGY, CBMG, USAT, SAIL, HERC, WTT. Stay away from those if you're new and if you're, don't know exactly how to go about the market. And another thing to do is obey just that first cut loss level. Like I said, if it fails, we're going to get more signals. This market is weird and crazy. And since I can't trust any great signal, I have to take all signals, cut and run quickly as possible from the ones that don't work, and ride and trim and trail the ones that do work higher. The highest quality long positions are GSM, PRTY, HEES, BBY, KFRC, and TPL. TPL, KFRC, HEES, and GSM are can slim and perfect speculator quality long positions. If you just use that first support level, you have greater than 10 to 1 reward risk ratio based on the most recent uptrend. Look at the most recent uptrend on GSM. Look at the PRTY uptrend off the November lows. HEES from the June lows. K-Force from the August, September lows. And TPL from the recent March, April, May lows. We're looking at over 10 to 1 reward risk ratios just using the first stop level. So even if all these signals are fake out signals, based on that reward risk ratio alone, I got to take a little bit. And that's why 0.5% goes into all the new long positions and 0.25% of my capital, anywhere from $1,000 to $1,250, goes into the speculative names. But I'm not going to load up on anything. I don't love anything. I just absolutely really like the reward to risk ratios, and know that the ones that work are going to more than make up for the ones that don't work as long as the market moves higher. Now, if the market continues to chop around, ends up rolling back over and heading lower, these are all going to fail. And so also with that being said, I've got 2 stop levels on the book. But if my very first stop level goes, like always, with it losing any of that catalyst, i.e. the green bop, i.e. pulls back on heavy volume, i.e. has some very ugly price velocity on the downside on a down session, I'm raising my stops up, either all of them or half of them. I'm not letting things, go bad. So like on RIBT, for instance, following this session on RIBT, so here we go. So first off, I go long RIBT here. I don't get completely filled that day, but boom, it has that session. I now then split my RIBT stops into here, here. I then put one here and then put one right there. The very next session, it took out those 2 stops. Well, that's it. That's crazy. I now move all of my stops up to 142. Unfortunately, on Friday, they didn't hit. It traded down to 141, but it did not take out my stops. So my new final cut loss is 140. But the whole point is, as RIBT's moving up, I'm moving my stops up immediately on big candles with big volume. And then when it reverses, I'm getting the hell out. Just like STML. STML, when it had this session here, I split up my stops that was here. So let's say I had 1, 2, 3, 4, 5, 6 stops. I then have 7. That one went out. I believe that day took out the 20-day moving average. Boom, I still have 6 stops, but half of my stops are out that low a day. Boom, that gets taken out. Well, I then now leave the rest of the stops on the book because it pulled back on lighter volume. It's not above average, so there's nothing to do. And then boom, another 50% sell signal. So now I'm out of all those previous stops. Now everything else I have, half gets moved up to here. The next day, boom, that's it. So now, my remaining stops on STML, today's low a day. And that's it. If it trades below 1350, I'm out of STML. But the bottom line is, since the market cannot ebb and flow, since it cannot do this, since it does this, and then does that, and then does this, and could possibly do that again, and will not be steady in an ebb flow manner, and or pull back more than 10% for more than a week. So this one pull back, you get 10%, but it doesn't even last 2 weeks, and boom, we're higher again. This one, we last about, a month, but how far do we pull back? 4%. Get the hell out of here. We can't have these kind of corrections in the easy market where I can easily load up on stocks until we have some better price action in the indexes. So as long as the indexes trade like this, I'm going to trade the way I do, but you have to be honest with yourself here. All of those signals this weekend, they're good, and there's a ton of them, and it was a lot of work. At the same time, if they all fail, I won't be surprised. It's the only way you can trade this market right now. You have to expect that whatever you touch could very well completely fail. So make sure your stops are aligned, make sure your position size is correct to your overall account capital, and make sure your risk is always in control. And that's going to be the case until we can consolidate for a period of time. Maybe it starts out on heavier volume, then ends on lower volume, then we start to move on real volume, and or can get a proper stair-stepping fashion market. But these V moves, it's making it tricky. But the ones to focus on, if you're new, GSM, PRTY, HEES, BBY, K-Force, and TPL, and I just noticed none of them are going to even risk you close to 5% if you're wrong to that first stop. All right, this is a long video. I got to wrap it up. Aloha.